Welcome to the deep dive, where we take that fire hose of earnings data, all the complex reports, and really just distill it down to what you need to know.
And today, we are diving into a real paradox. We're talking about Citigroup's Q4 2025 earnings.
A quarter so complex, so noisy, it almost needs its own instruction manual to figure out.
It's the ultimate study in contrast, isn't it? You've got this huge global bank, and at first glance, the numbers look, well, they look pretty troubling.
Right. A miss on Wall Street revenue estimates, a big drop in their reported profit.
And yet, somehow, at the same time, they delivered this really significant beat on their adjusted earnings per share. It's confusing.
That is the core riddle we're going to try and solve today.
Yeah.
Citigroup is in the middle of this massive transformation. The CEO, Jane Fraser, she calls it pivotal.
And it is. It's probably one of the most complex restructurings in modern finance. So this Q4 report wasn't just another quarter. This was the big show me moment.
Yeah, the market has been patient, but that patience was running out. They wanted to see proof.
Exactly. Proof that all the painful changes, the divestitures, the tech upgrades, all of it is actually creating a stronger, more profitable bank underneath.
So our mission for you, the listener, is to cut through all that noise. We're going to use a 5-part framework, basically walking you through the 5 key slides they presented to Wall Street.
We want to get past the one-time charges and all the accounting quirks to find the real underlying health of the bank's core businesses.
Our journey starts with that headline scorecard, the whole miss versus beat thing. Then we'll dig into profitability metrics like ROTCE.
From there, we go into the engine room, right, the 5 core business segments to see what's actually working. And we'll finish up with the balance sheet, shareholder returns, and what management is promising for 2026.
Okay, let's jump right in and clear away some of this fog. Now for slide 1, the at-a-glance scorecard.
Okay, so this is where the story gets really complicated right away. It's this dichotomy between what the business is actually doing and what the accounting numbers show.
Let's unpack that. So Citigroup reported total revenues of $19.9 billion.
Right, and on paper, that's up 2% year over year. So, not terrible, but not great either, just sort of treading water.
But that $19.9 billion figure was the first red flag, because Wall Street was expecting more.
A lot more. The consensus estimate was around 20.5 billion. So that's a revenue miss of about 3.16%.
And in the world of big banks, missing on the top line like that gets punished pretty hard. It signals maybe waning demand or some kind of weakness.
For sure. And it definitely drove a lot of the initial negative stock reaction. But here's the vital distinction, the hidden engine that we have to talk about.
Okay.
That reported 19.9 billion. That's the messy number. It includes all the negative hits from businesses they're selling off, especially the final exit from Russia.
So if we strip out that noise, that non-operational drag, what was the real core revenue?
The underlying or clean revenue from the 5 businesses they're actually keeping was $21 billion.
Wow. Okay, that's a massive difference. A full $1.1 billion higher.
It's huge. And that $21 billion, that represents a really robust 8% growth rate year over year.
So what you're saying is the core strategy is actually working. The engine is running fast, but it's just being obscured by all this legacy baggage they're finally getting rid of.
That's it exactly. The new, leaner bank is growing at 8%. The old, messy bank is dragging the headline number down to 2%.
Which brings us to the bottom line. And more noise. The reported net income was $2.5 billion.
Which was a sharp 14% decline from the year before, and that meant diluted EPS, or earnings per share, fell 11% to $1.19.
And that's the big scary number that grabbed all the headlines.
It is. And maybe we should just quickly touch on why we always focus on diluted EPS, not basic.
Yeah, good point. Why is that the professional standard?
Because it's just the most conservative and honest number. Diluted EPS forces you to assume that every single thing that could become a share lot, like an employee stock option, has become a share.
So it increases the number of shares in the calculation.
Right. It inflates the denominator, which gives you a lower, more conservative, and frankly, a truer picture of what each shareholder is actually earning. That 119 is the worst case statutory profit.
Okay, so GAAP profits are down, revenues missed. A double whammy. But the big story was the beat.
This is where it gets interesting, because the market is smart enough to look past stuff that's truly a one-off Analysts immediately zeroed in on the adjusted EPS of $1.81.
And that number strips out all the legacy cleanup charges.
Exactly. And that 181 blew past the consensus estimate of $1.70. That's a strong, undeniable beat on core operational earnings power.
So, a miss on SHAP revenue, a beat on adjusted profit. You'd think the beat would win out, but the stock price tells a different story.
It sure does. Despite that strong operational beat, the stock dropped 4.14% right after the announcement.
What does that sell-off tell you?
It tells me investors were worried about two things. First, that revenue miss, even if it was technical, it still spooks people. And second, the really high and still growing costs of this whole transformation.
Yeah, the analyst chatter was all about the messy quarter and basically a demand for a show-me year in 2026. They saw the beat, but they're focused on the costs.
Which takes us right to the core problem. How can revenue grow 2% while profits fall 11%? There are three big levers at play here.
Let's start with the one that's most worrying for the future. Negative operating leverage.
So, operating leverage is all about efficiency. Positive leverage is the goal. That's when your revenues grow faster than your expenses. Your profit margins expand. It's a beautiful thing.
And Citi had the opposite.
The exact opposite. Jeep revenue, as we said, grew 2%, but their total operating expenses grew much faster, up 6% to $13.8 billion.
That's the textbook definition of negative operating leverage.
Yeah.
You're spending more to bring in less.
You are. You're spending 6 cents more to get just 2 cents of new revenue. That crushes your margins.
And what's driving those costs up so much?
Well, it's a few big things. Higher pay and benefits, for one. They're hiring a lot of compliance staff. Then there's this massive spending on technology to modernize their ancient systems. And finally, you have elevated legal costs to clean up old messes.
So they're spending a ton of money now, hoping for savings later.
Right. The problem is the spending is happening now and the savings are overwhelmed. It makes hitting their profit goals really, really tough.
Okay, so that's lever number one. What's the second one?
The second lever is the cushioning effect of share buybacks. This is why the EPS drop of 11% wasn't as bad as the net income drop of 14%.
So this is just pure math.
Pure math. Citi has been buying back its own stock like crazy. When you do that, you reduce the number of shares out there.
The denominator in the EPS calculation.
Exactly. So even if your net income, the numerator is falling, you're dividing it by a smaller number, which props up the final EPS figure. It's a way to defend shareholder value during a messy period.
A crucial defense.
Okay.
And the third and final lever, the big one.
The notable item distortion.
Yeah.
This is all about the Russia sale. It was a roughly $1.2 billion pre-tax loss.
But the real poison was in the tax treatment of that loss, right?
Precisely. This kind of loss, which comes from realizing old currency translation losses, had a very limited tax benefit. Normally, a big loss gives you a big tax shield.
But not this time.
Not this time. So the loss hit their bottom line almost dollar for dollar. It drove their effective tax rate for the quarter up to a crazy 34%, way up from 24% a year ago.
So that extra tax bill was the final thing that just crushed the reported JAF number.
It was, and that's why when you strip out that $1.2 billion charge, the adjusted numbers look so much healthier. It was all a legacy cleanup.
Okay, so slide 1 shows us the core is working, but the cleanup is expensive and creates a ton of accounting drag.
That's the perfect summary.
Moving to slide 2, the engine of profitability.
Right, so we're moving past the headlines now and into the real gauges of efficiency. It's not just about how much money you make, but how well you used your capital to make it.
And we're starting with the gold standard for banks, return on tangible common equity, or ROTCE.
Yeah, understanding ROTCE is so important. It measures your return only on hard capital. It strips out intangible stuff like goodwill from old acquisitions. It basically asks, for every dollar of real hard cash shareholders put in, how many cents of profit did we generate?
So what was the number and why does it look so weak?
The reported statutory ROTCE was just 5.1%. And frankly, that's not good enough. It's way below their cost of capital, which is probably closer to 10%.
So on a reported basis, they're destroying shareholder value.
Correct. But again, we have to look at the adjusted number. When you strip out that Russia charge, the adjusted ROTCE jumps to 7.7%.
Much healthier, but still not where they need to be.
That's the critical gap. 7.7% is okay, but their own target for 2026 is 10 to 11%. Bridging that last gap from 7.7 to 10 is incredibly difficult.
What's it going to take?
billions in cost savings or a massive acceleration in revenue. I mean, to put it in perspective, a bank like JP Morgan often runs with an road PCE over 15%. Citi is just trying to get into the low double digits. The transformation is just not done yet.
And that cost problem takes us right to the next metric, the efficiency ratio.
This is the simplest measure of all. It's just your expenses divided by your revenue. How much does it cost you to earn $1? And the benchmark for a really efficient bank is somewhere below 60%.
And Citi's nowhere near that.
Not even close. They came in at 69.6%, so they're spending almost 70 cents to earn $1. And what's worse, that number is deteriorating. It's up from 67% a year ago.
So they're getting less efficient, not more. Why?
It's this dual burden they're carrying. On one side, you have what are called stranded costs. These are leftover expenses from businesses they've already sold.
So they're paying for a bank that doesn't exist anymore.
In a sense, yes. The IT systems, some of the back office functions, they still have to pay for that until the wind down is complete. And on the other side, you have the huge investment in new technology.
The spending hits the books now, but the benefit comes later.
Exactly. The efficiency gains from that new tech are probably 12 to 18 months away. Right now, it just looks like a massive drain on profits.
Okay, let's go back to that Russia charge for a second, because the accounting here is really confusing, but so important to why the quarter looks the way it does.
Right. This is the $1.2 billion pre-tax loss. And we need to understand the mechanics of this, the currency translation adjustment, or CTA.
Give us the analogy we talked about.
Okay, so imagine Citi's Russian business was like a house they bought years ago with US dollars. But the value of that house is priced in rubles. Over the years, especially recently, the ruble has gotten crushed against the dollar. So the value of that house, when you translate it back into dollars, has shrunk dramatically.
So every quarter, they had a paper loss on the value of that house.
A huge paper loss. But accounting rules say you don't put that on your income statement right away. You stick it on your balance sheet in a special account called AOCI. It's just balance sheet noise, unrealized.
Until you sell the house.
The second you sell the house, you have to make that noise real. The rules say you have to take all those accumulated years of paper losses out of that balance sheet account and hit your income statement with them all at once.
So that $1.2 billion charge is basically a decade of ruble depreciation hitting the P&L in a single quarter.
That's it. It's the final closing chapter. Jane Fraser's team just ripped the Band-Aid off. It has nothing to do with how the core businesses are performing today.
Which is why the market is right to ignore it as a one-time event.
Absolutely. It's pure accounting distortion.
Moving to slide 3, the engine room business segment performance.
This is the real proof point. We're looking at the 5 core businesses that make up the new Citi. This is where we see if the strategy is actually working.
And let's start with the one everyone loves, services, the crown jewel.
Services had just a fantastic quarter. It completely validates their strategic focus. Revenue hit $5.9 billion, up a very impressive 15% year over year.
And net income was even better, up 20%. This thing is a profit machine.
It is, and it's driven by 2 main parts. First, you have Treasury and Trade Solutions, or TTS. We call this the plumbing of global finance.
Right, they handle cash management and payments for huge multinational companies.
And TTS revenue grew 6%, mostly because their net interest income surged by 16%. They are making a killing on the spread on all those corporate deposits. It's very sticky, stable revenue.
But the really explosive growth came from the other side of services.
It did. Securities services, their custody business, revenue there just exploded by 43%.
43% in a custody business is insane. What drove that?
A 24% increase in assets under custody. That means they're winning huge new contracts from pension funds, asset managers. It's a massive vote of confidence in their institutional franchise.
So services is the reliable engine. Now for banking, which was the big recovery story this quarter.
Yeah, the jump here was just massive. Revenue was up 78% to $2.2 billion, and net income was up 92%.
A near doubling of profit. That signals a huge shift in the market.
It's the loudest signal yet that the global deal-making environment is finally thawing out. For most of last year, high rates just froze the M&A market. Q4 was the breakout.
And where did they see that strength?
Investment banking fees were up 35% overall, but the real standout was advisory M&A fees, which surged 84%.
Corporate confidence is back.
It's back. And debt underwriting was also strong, up 19%. The other big piece was corporate lending revenue, which was up almost 200%. But that was more due to some internal accounting changes and less hedging pressure. Still, a huge turnaround for the whole division.
Okay, now for markets, the trading division, the volatility trap.
Yeah, this was a tough quarter for them. Revenue was basically flat, down 1% to $4.5 billion.
And the problem was the comparison to last year, right?
Exactly. Q4 of 24 was super volatile, which is great for trading desks. This quarter was much calmer. Both fixed income and equities slipped about 1%, mostly because of lower activity in rates and commodities.
And when revenue is flat in a trading business, the bottom line gets crushed.
It gets absolutely crushed. Net income dropped a sharp 22%. Revenue was flat, but expenses for that global trading floor, the people, the tech, were up 14%.
Textbook negative operating leverage again.
The perfect example. High fixed costs are a killer when revenue stalls.
Okay, let's check the pulse of the American consumer with U.S. personal banking.
USPB had a solid quarter, revenue up 3%. But the real story was profitability. Net income surged an incredible 116%.
116%. What on earth drove that?
While the revenue growth came from their branded cards, which were up 5%, people are carrying higher balances, which means more interest income for Citi.
But the profit explosion had to come from the credit side.
It did. Net credit losses actually dropped 7% year over year. That's a huge economic signal. It says the U.S. consumer is still really resilient and paying their bills.
And they also released some reserves.
Yes, that's a big deal. A reserve release means they think the economic outlook is better than they previously feared, so they can move money from their rainy day fund back into profits. It's a sign of confidence.
Got it. Fewer losses and more confidence equals a massive profit jump. Last one, wealth. The turnaround project.
Wealth had pretty good top-line growth. Revenue was up 7% to $2.1 billion. They're definitely attracting wealthy clients' cash.
But the net income was flat, up just 1%. What's the disconnect?
It's the cost story again. Revenue grew 7%, but expenses grew 6%. The cost to serve these wealthy clients, the advisors, the tech, is just really high right now. They're in investment mode.
So the margin isn't there yet.
Not yet. That's the big focus for them in 2026. They have to make that revenue growth actually drop to the bottom line.
So a very clear picture from the segments. Services and banking are superstars. The consumer is healthy. But markets and wealth are fighting a cost battle.
That's the map right there.
Moving to slide 4, financial strength and shareholder rewards.
Right. So this is about the bank's shield, its balance sheet, and how it's rewarding the people who own the company.
And we start with the big one. The CET1 capital ratio. It came in at a preliminary 13.2%.
That's a really robust number. The CET1 ratio is the main measure of a bank's ability to absorb a shock. And 13.2% is about 160 basis points above what regulators require them to hold.
So that 1.6% is basically a strategic buffer of excess capital.
Exactly. And that buffer gives them huge flexibility to invest, to weather a downturn, and most importantly for this quarter, to return a ton of cash to shareholders.
The other key metric for value investors is tangible book value per share.
Yeah, TBV is what the bank would theoretically be worth if it were liquidated tomorrow. It's a floor on the valuation. And Citi grew its TBV per share to $97.06.
Which is an increase of 9% year over year.
Which is really impressive. To grow your intrinsic value by 9% during such a messy restructuring year is a very strong sign of fundamental value creation.
And that value creation leads right into their capital return policy, which has been incredibly aggressive.
Super aggressive. They returned about $5.6 billion to shareholders in Q4 alone. For the full year, it was almost $17.6 billion.
And here's the craziest number of the whole report. The full year payout ratio was 133%.
I'm glad you brought that up. It sounds unsustainable, right? 133% means they return more cash to shareholders than they actually earned in profit.
It sounds like they're draining the bank, but they're not.
They are not. It's a deliberate strategic move. They're taking that 160 basis point capital buffer we talked about and deploying it. They're saying our stock is cheap, and the best use of this excess capital right now is to buy it back and accelerate returns to our owners.
So it establishes them as this capital return machine.
For sure, and it provides this invisible support for the stock price. Every share they buy back makes future earnings per share mathematically higher. It's a powerful tool.
Moving to slide 5, the road ahead management's outlook and key takeaways.
This is where it all comes together. What is management promising for 2026? Because at this point, that's all the market cares about.
CEO Jane Fraser called this quarter the culmination of a pivotal year. Her commentary was very positive, talking about record revenues in the core and claiming positive operating leverage for the full year.
Yeah, she's trying to frame the Q4 expense spike as a blip, not a trend. She's trying to convince the market that the worst of the spending is over and costs are about to flatten out.
And the most important thing she did was explicitly reiterate their number one goal, a 10 to 11% ROTCE target for 2026.
That is the only number that matters now. By sticking to that target, management is making a huge promise. They're saying they believe they can get costs under control and hit double-digit returns next year.
It's their line in the sand. If they miss that, their credibility is in serious trouble.
Absolutely. Okay, so let's wrap this up with our 4 key investment takeaways.
Go for it. Takeaway number 1.
The transformation is real, but the legacy burden is still being shed. That huge gap between adjusted EPS and GAAP EPS is the proof. The core bank, with services up 15% and banking up 78%, is strong.
Takeaway 2. Banking and services are the twin growth engines.
The results completely validate their focus on corporate clients. Services is the steady, reliable engine, and banking is proving it can compete and win when the M&A market turns on.
Takeaway 3. Aggressive capital return is a key part of the investment thesis.
That 133% payout ratio is a strategic choice. They're using their fortress balance sheet to create value for shareholders through buybacks, independent of the messy quarterly earnings.
And finally, takeaway 4.
2026 is the true show-me year for cost control. The path from 7.7% ROTCE to 10% is all about costs. The excuses are over. They have to deliver efficiency now.
So, to synthesize it all, this quarter was a perfect snapshot of the whole Citi story. Underneath all the turbulence and the ugly headlines, you have a simpler, more focused bank that is executing its strategy pretty well.
Right, and the negative stock reaction wasn't a vote against the strategy. It was a signal of investor impatience. The market is basically shouting, the restructuring is done, now show us clean, consistent profits.
Which leaves us with the one critical question for 2026. We know the core engine is strong, but can management finally get control of the bank's high, sticky fixed costs and deliver the positive operating leverage they need to hit that 10 to 11% ROTCE target?
And if they do, will the market finally reward them for it? That's what we'll be watching for the next 4 quarters.
That's the only number that truly matters now.
That's it for this deep dive.
Now for the mandated disclaimers.
Yeah.
Please remember that this report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities.
All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided.
Additionally, this report was generated by an artificial intelligence model, integrating data directly from the company's official press release data with public market data. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. Users must independently verify all information.
Like and subscribe to StockAnalytics.ai YouTube channel. Unfortunately, we have been demonetized from YouTube, so we have now shipped off to our StockAnalytics.ai website. For $5 a month, users will get exclusive access to the S&P 500 and NASDAQ 100 libraries, as well as video requests.